How do you incorporate it in the bond market right now? I've been talking for a week now about this new compression in two-year yields. Are bonds priced to perfection?
Well, the bond market is essentially telling you that while there might be a lot of supply heading our way, there's quite a bit of demand for that supply coming both from central banks as well as from the private sector who need a place to park their cash while the economy is getting back into sort of a normal state of affairs over the coming years. So the bond market is saying, hey, look, we understand there's going to be a lot of cash on the sidelines. It's going to have to find a place to hide. And, even though a 60 basis point 10-year yield does not look attractive historically, the reality is that there aren't too many other sovereign bond markets out there with the type of risk characteristics that the Treasury market, for example, offers, and saying, hey, people are satisfied with 60 basis points.
Matthew, what do you do with high yield?
Well, Francine, I think you take a cautious approach in that, in any time we wade into the corporate bond market, over the past several years, we've taken a very up in quality approach to it. Now that we've got a bit of a backstop with what the Federal Reserve is offering to do, that does kind of push us a bit out the risk spectrum. And that's sort of the point here. The point is that the Fed wants to backstop the riskiest markets out there, and they're trying to encourage stability in the risk-less markets like the Treasury complex to get investors to feel more comfortable putting money to work in those riskier assets. So, over the course of the past couple of months, we have gradually been extending out our view on risk-taking, along with Mike Wilson in the equity market. And so we are getting more optimistic on some of these riskier assets like high yield.